If you are planning to sell your home in 2026, or if you sold it in the past 2 years, there is one form the CRA requires on your tax return that most Canadians have never been told about. Not a complicated form, one schedule, one box that needs to be checked. And if it is missing, voor onder keer kunt je denouder TR, even when your home sale is completely tax-free, even when you owe nothing, even when you did everything right. The CRA can deny your principal residence exemption entirely and tax a gain you were never supposed to pay tax on. For some Canadian homeowners, that tax bill is reaching into the tens of thousands of dollars on a sale that should have cost them nothing. Stay with me, because by the end of this video, you will know exactly what this form is, why most Canadians have never been told it exists, and the 3 situations where homeowners are being caught right now in 2026. This channel exists for one reason: to make sure every Canadian homeowner never pays a penalty they did not know was coming. Subscribe and turn on notifications right now so this information always reaches you before the CRA does. But first, tell me in the comments right now, did you know that selling your home, even completely tax-free, requires a specific form on your CRA return? Yes or no? Drop your province below. Because the number of Canadians who have sold a home without knowing this form existed is something this community needs to understand together. Lorraine is 72 years old. She retired after 28 years as a nurse in Winnipeg, Manitoba. She receives CPP of $860 and full OAS. In 2023, she sold the home she had lived in for 19 years and moved into a condominium closer to her daughter. She made a significant profit on the sale. She had lived there the entire time she owned it. Every dollar of that gain was exempt from capital gains tax. Lorraine had always filed her own taxes using basic software. She entered her pension income. She claimed her medical expenses. She submitted her return. She did not report the home sale. Not because she was hiding it, because she had sold homes before and nobody had ever required her to report them. She did not know the rules had changed. 14 months later, she received a CRA reassessment notice. The CRA had identified the sale through land registry records. Because no principal residence designation had been filed on her return, no Schedule 3, no formal exemption claim, the CRA assessed the full capital gain as taxable income. The reassessment included tax owing on the gain, plus arrears interest, calculated from the original filing deadline. Lorraine had done nothing dishonest. She had lived in that home for 19 years. The gain was legitimately exempt. But because the exemption was never formally claimed, the CRA processed the sale as an unreported capital gain. The reassessment took 8 months and over $1,800 in accounting fees to resolve. She told her daughter afterward, "I had no idea I needed to file anything. I thought tax-free meant I did not have to report it." And the worst part, Lorraine is not alone. Across Canada right now, homeowners are selling properties, reporting nothing on their return, and receiving CRA reassessment notices months later for gains they never should have owed tax on. Not because they did anything wrong, because one form was missing. Now here is where it gets really interesting. And honestly, this next part is the reason I made this video. The rule change happened in 2016. Before 2016, the CRA did not require homeowners to report the sale of a principal residence on their tax return at all. You sold, you moved, you kept the money. The exemption was assumed. Starting with the 2016 tax year, the sale of every principal residence must now be reported on your income tax return. The gain must be calculated. The exemption must be formally claimed using Schedule 3 of your T1 return, with the principal residence designation made explicitly on that form. The exemption does not apply automatically anymore. You have to claim it. And if you sold your home and your tax preparer, or you yourself, did not include Schedule 3 and did not formally designate the property as your principal residence, the CRA can assess the full capital gain as taxable income. Not a portion, all of it. Tell me in the comments right now, did your accountant or tax preparer specifically mention Schedule 3 and the principal residence designation when you sold your home? Yes or no? I am reading every single comment. Now let me show you the 3 situations where this is catching the most homeowners right now. Situation number 1, the home sale that was never reported at all. Lorraine's situation. A homeowner sells, assumes tax-free means nothing to report, files a return with no mention of the transaction. CRA identifies the sale through land registry. Reassessment arrives. This is the most common situation, and the easiest to fix going forward. If you are planning to sell in 2026, confirm with your tax preparer before the sale that Schedule 3 will be included on your return for the year of the sale. Ask them specifically to confirm the principal residence designation will be formally claimed. Do not assume it will be done automatically. If you sold in 2022, 2023, 2024, or 2025 and are not certain whether Schedule 3 was included, log into your CRA My Account and pull up the return for the year of the sale. Look for Schedule 3. If it is missing, contact a tax professional immediately about filing a T1 adjustment. You have up to 10 years to amend in most circumstances. Situation number 2, the rental suite that changes everything. This is the situation generating the most audit activity among Canadian homeowners right now in 2026. And it is the one most people have the hardest time understanding when the CRA letter first arrives. Many Canadian homeowners particularly seniors who own a larger home, have rented out a basement suite, a secondary unit, or a portion of their property at some point during their ownership. If you claimed rental income on your return during those years, the CRA may take the position that the rented portion of your home was not covered by the full principal residence exemption when you sold. This does not automatically mean you owe tax. There is a CRA administrative policy called the ancillary use position that protects homeowners in certain circumstances. If the rental was ancillary to your main use of the property, if you did not structurally alter the home to create a self-contained separate unit, and if you did not claim capital cost allowance on the rental portion, the full principal residence exemption may still apply. But you have to know this position exists. You have to claim it correctly on your return. And if your tax preparer was not aware of the nuance, the CRA may assess a portion of your gain as taxable without the ancillary use position ever being raised in your defense. Eugene is 69 years old. He worked 32 years as a postal carrier in Dartmouth, Nova Scotia. He and his wife Patricia sold their home in 2024. They had rented their basement suite for 11 years. A fully self-contained unit with its own entrance and kitchen built by the previous owners. They reported rental income every year. They never claimed capital cost allowance. When they sold, their accountant filed Schedule 3 correctly and claimed the principal residence exemption. But because the basement suite was self-contained with a separate entrance, the CRA challenged the ancillary use position and assessed a portion of the gain attributable to the rental area as taxable. The resulting tax bill was $11,400. Eugene and Patricia had done nothing wrong. But the interaction between the self-contained rental unit and the principal residence exemption produced a tax bill they had never anticipated and never been warned was possible. If you have ever rented any portion of your home and are planning to sell, speak with a tax professional before you list. Understand whether your rental use was ancillary or structural. Do not discover this for the first time in a CRA reassessment notice after the sale is complete. Situation number 3, the cottage or vacation property that was never formally designated. Many Canadian homeowners own a second property. A cottage, a cabin, a vacation home, in addition to their primary residence. Most of them know that only one property can be designated as a principal residence in any given year. What most of them do not know is that the principal residence designation is flexible. A taxpayer can designate different properties for different years, and in certain circumstances, designating a vacation property as the principal residence for specific years can significantly reduce or eliminate the capital gain on its eventual sale. This is not a loophole. It is an explicit feature of the principal residence exemption rules. But here is the point that matters. If you own a cottage or vacation property and you have never formally designated it as a principal residence for any year, and you eventually sell it with a significant capital gain, you may be paying capital gains tax on gains that could have been partially or fully sheltered if the designation strategy had been used while it was still available. Once the property is sold, the opportunity is gone. The designation must be made on the return for the year of the sale at the latest, and ideally planned in advance with a tax professional who understands how to optimize the allocation of designation years across multiple properties. Canadians who work with tax professionals who understand the principal residence exemption have this conversation proactively before they sell. Most Canadian homeowners are not having this conversation at all because nobody told them it was necessary. Now you know it is necessary. Before you sell, here is your action checklist. Step 1. If you are planning to sell your home in 2026, confirm with your tax preparer before you sign the listing agreement that Schedule 3 will be on your return and the principal residence designation will be formally claimed. Step 2. If you sold in 2022, 2023, 2024, or 2025, log into your CRA My Account and check the return for the year of the sale. Look for Schedule 3. If it is missing, contact a tax professional about a T1 adjustment today. Step 3. If you have ever rented any portion of your home and are planning to sell, speak with a tax professional about the ancillary use position before you list, not after. Step 4. If you own a cottage or vacation property, speak with a tax professional about the designation year strategy before you sell either property. Step 5. Share this with any homeowner who sold a home in the past 5 years and filed their own taxes, or whose accountant filed quickly without discussing the sale in detail. What surprised you most from this video? The fact that the exemption is no longer automatic. The rental suite interaction, or the cottage designation strategy. Drop your province and your answer in the comments. I read every single one, and if this helped you, hit the like button right now. 1 second. It is the only way YouTube shows this to the next Canadian homeowner who is about to sell without knowing this form exists. Lorraine resolved her situation. The exemption was applied. The gain was confirmed tax-free. But it took 8 months, and money she did not plan to spend at 72 on a fixed income. One form, filed correctly, would have prevented all of it. You now know the form exists. You know what it requires, and you know what happens when it is missing.